There's a question of December 2013. Question of December 2013. Question number 5B. Question number 5B. And the question is on pages 85 to 86. Now, this question does not have much to read. There's nothing much to read, so we can just design how it will look like. Just design. So we have details here. We have details. Then we have the year 2014, 2015, 2016, and 2017. Then we have project 1, 2, 3, not 3. Project 1, 2, 1, 2, 1, 2. So this is performance. Measurements. Statements. Okay, so the first thing is opening value. opening value. And this opening value, you can designate it as A. You can call it A. Then it will be followed by depreciation. Be followed by depreciation. Depreciation, you can call it B. And call it B. It will then be followed by closing value. Closing value, which you can call this one, closing value. We are just going to get it as A minus B. It will be A minus B. And I can try to put the buffer here. I don't get too much lost. So for project 1, as you can see up there, if our table is in thousands, it is 10,240. So the opening value is 10,240. And according to information 1, it says the initial capital outlay is to be amortized evenly over the project's life. So we are going to spread it over 4 years equally. So divide this by 4. 10,240 divided by 4. 2560. So that is the depreciation. 2560. So subtract that. 7680. Now let's take that value to 2015 for project 1. So you open with 7680. 7680. Bring the depreciation of 2520. Oh, 2560, sorry. We have 5120. Now 5120, take it to the third year. 5120 less depreciation of 2560. We close with 2560. Then open here with 2560. Close with 2560. Sorry, less 2560, and you close with 0. Close with 0. Let's done the same rhythm for project 2. Project 2, it had 8320. 8320 divided by 4. 2080. So you get what? 6240. So we have 6240 here. You less 2080.
4160.
4160. So 4160. You less 2080. 2080. Then you bring 2080, you less 2080, and you get a 0 there. You get a 0 there. The next one that you need to bring is called cost of capital. Cost of capital. And this cost of capital, we will designate it C. We shall designate it C. And how we shall get it, it is, we look at information 3, it is 16%. So this C, I don't know whether you have space, modify yangu. You include the formula. That is cost of capital. Now this cost of capital will be 0.16 of A, we call it C. It will be 16%. And we already use the opening value. So let's start the first one. 16? 38.4.
13, that's 1.2.
12?
28.8. 998.4. It's 19.2. 665.6. 49.6.
4?
49.6.
332.8. That is the cost of capital. Okay. The next one, we bring the cash flow. And this cash flow, we will call it B. Cash flow, we call it B. Cash flow, we call it B. We are just going to record as provided. For the first project, we have 3840. Second project, we have 4160. Then 3840. 3520. Then 3840. 2400. 3840 and 1600. So those cash flows are S provided. Then we get the income. Now, income will be given as the cash flow B minus the depreciation, which we call B, and the answer we can call it E. The answer we can call it E. The answer we call it E. So, ya kwanza. 1280. 20. 80. 1280. 14. 40. 1280. 320. 1280. Negative 480. Negative 480. Okay, the next one is residual income. Residual income. Residual income. So residual income will be E minus the cost of capital, which is C. It is E minus C.
Negative 10,
5, that's 5. 0.4. 748.8. 441.6. 460.8. 3. 0.6 or 0.8? Here for 345.8. 0.6. Because this one is a 6, this one, eh?
It's 70.4. It's
870.4.
Negative is 12.8.
It's 12.8. Oh, this one is a negative. Everything else okay, eh? Then huyo mwingine anaitwa return on investment. Return on investment. And this return on investment, you will get it as income. That is E. You divide by A, the opening book value. You multiply by 100. E, you divide by A. You multiply by 100. Negative? No. Umetumia hii instead of this one. Umesema 12.5%. 25%. 16.7%. 23 points.
3.08.
So we can make it 1%. 1 decimal. Confine ourselves to 1 decimal. 25%. 7.7%. 50%. 50%. Negative 23.1%. So we are okay at that point, yeah? Okay. So from there, I want us to get the average or the summary, or we just call it average. So we have the project, then we start with the residual income. Residual income for project one. So project one, the residual income is minus 358.4 plus 51.2 plus 460.8 plus 870.4. Now all this you divide by 4. So we're just taking those values. Nasema 256. 256. Let's get project 2 residual income is 748.8 plus 441.6 plus minus 345.6 plus minus 812.8. You divide by 4.
8.
You get 8. So that is as far as residual is concerned. Let's done the same rhythm for return on investment. Return on investment. Return on investment. So project 1 has 12.5 plus 16.7 plus 25 plus 50. You divide all this by 4.
26 and 5.
Huh?
26 and
0.05.
Yes.
We do the same with the other one, that is 25 plus 23.1 plus 7.7 plus minus 23.1. You get 8.175. $8.175. So the advice is we should select if you're able to do it in a tabular way, you can still extend here. You're able to do it in a tabular way. So we will select project 1 when you are using residual income. You got the highest or the higher. Similarly, even here, we shall select project 1. When you're dealing with these performance measurements, there is something we call dysfunctional consequences. Dysfunctional consequences. One, right? Divisional managers selecting projects with huge inflows in the short run and huge outflows in the long run. First of all, this threatens the going concern of the company. This threatens the going concern of the company. Number 2, divisional managers resorting to unpopular labor policies. To meet the targets. Unpopular labor policies to meet the targets. This demotivates workers. This demotivates workers and eventually creates customer dissatisfaction and eventually creates customer dissatisfaction. Now, last time I told you performance measurement is simply an exercise where we compare the expected performance and the actual performance, and the difference between the two we said is called variance. And we therefore said it is the same thing that we were doing when we started costing. It's only that here we were talking of the standard value, and then here we were also talking of the actual. Then we could get the variances. Now, this variance will either be favorable or they will be adverse. They will either be favorable or adverse. Now, when we get what we get, action must be taken. Someone who has reported a favorable variance will be rewarded, and someone who has reported an adverse variance will be punished. Now, these rewards and punishments may have far-reaching effects. For example, if you look at reward, maybe someone is promoted, and all of us, we would want to be recognized and promoted to become wanamkubwa. And some of them even come with huge cash flows. There are companies that pay a lot of money for that. And when it comes to punishment, that can even mean you being demoted. It can mean your salary being deducted. It can mean even you being fired. When you look at it that way, then you find that these actions, they have what we call impactful or far-reaching impacts on the life of the subject of appraisal, who happens to be the worker. If you are the one being appraised, and you know that courtesy of these results, you will get a promotion, then you will do anything possible to post the results that are required by your bosses to get the promotion. If you know courtesy of these results, you will be punished. Then again, you will do anything possible to ensure that you avoid that punishment. Now, in doing all that is possible, then there comes in what we are calling the dysfunctional consequences. Now, something is called dysfunctional if it is now fulfilling a different purpose than what it was initially intended. Like this evening, I've come to this class to teach AMA. If I start teaching music, I'll still be functional, but I'll be deemed to be dysfunctional because what I'm teaching is not what I was initially intended to teach. And more so when it is adverse. Now, looking at these results here, in companies, performance is done per period. Most companies is per year. In a school like this one, our performance is done per semester. Performance is done per semester. Every semester in Kisha, whoever is in charge of studies, anaangalia nani amemaliza syllabus, nani hajamaliza, na hiyo report inapelekwa kwa principal. Ndio principal anajua nani yako kazi next semester, nani hayuko kazi. Every semester. Kitabo ilikuanga 5 months, using every 3 months. Like now, next week, a report should be tabled to the principal. Nani amemaliza syllabus, nani hajamaliza. Every 3 months. For companies, it is 1 year. Now, ukijua that you are going to be appraised on the results of the first year, using the residual income, you can see this one has reported a negative, and this one has reported what? A positive. Assuming your company, the policy is that the residual income you report will be adjusted or will be included in your payroll. As in, kama umeonyesha negative, at the end of the salary, payroll yako itaonyesha negative 358. Kama umereport hii End of the month, this is what now you will be added. So which project would you select? Project 2. Ndio uongezewe hii badala ya ukatwe. From your net pay, hapa watanoa hii. Lakini hapa watakuongezea hii. So anyone, you and me being the worker or being the one appraised, we would go for this. But now look at what happens. And that's what we have called selection of projects with huge inflows in the short run, but huge outflows in the long run. Now look at what happens. Second year, we want to improve from 358 negative to 51. While this one is coming down. That year, we want to talk 51 and end all the way to 460. We want to shuka from 441 to a negative 345. Fourth year, we want to improve almost double, 460 to 870. Hapa, we want to shuka. So if you are the owner of this company, then going to the fifth year, utakuwa kwa negative. Hapa itabidi you borrow. So you are now operating using liabilities. And when you start operating using liabilities, your debt is almost guaranteed. But this fellow is operating at a positive of what? 870. Now, mkianza mashindano competition, in the 5th year, 6th year, this guy will give you a knockout. Because you are weak financially, wewe kwa madeni, yeye ako na surplus. That's why tumesema the going concern of this company becomes what? Threatened. This guy can even afford to poach all your workers. Because kwako saa hii ukiwa kwa negative, you have started experiencing delayed salary payments. Maybe hata umeanza kuthreaten watu utapunguza mshahara. All those things you could be familiar with those things. So your workers are already now unsettled. Alafu huyu jamaa waitie pesa kidogo ama waambie kujeni hapa kwangu mshahara haitawachelewa. They will move quickly. And when they move, then you are so weak. So the going concern of the company becomes threatened. The other thing is, when I realize that if I don't hit my targets by the required time, I'm going to be punished. Then the manager resorts to what we call unpopular labor policy. This is where you realize there are targets that must be met. So mkubwa anatoa memo, anasema kesho kila mtu akue hapa by 6. And no leaving office until you deliver this report. Now, for you to deliver that report, you might be in that office until 11 p.m. Na kesho, you are still required to be there. So what happens? And normally unastahili kutoka job 5. Makasiriko tu, hakuna kitu kingine because hakuna kitu unaweza fanyia mkubwa, si ndio? Memo ishatoka. Na ukijaribu kuenda kesho utapewa barua. So unakaa hapo unangangana mpaka 11 umechoka. When going home, this guy does not even give you an allowance of 1,000 uchukue taxi, which now being mtu wa kawaida hapa chini hivi ungeweza kuchukua matatu ya 50 bob na uchukue boda ukifika karibu na kwenu ya 100, sio ni 150 ubakishe what 50. Hiyo unaweza nunua nyama kule utulie kidogo. So this guy anawapanga wewe na wewe ni Wadhika route, anaita taxi moja peleka hapo, hii na hii ni wa Jogoo route. So there is nothing you get. Now some of us, we already have some people who will question where we are coming from. So you get to the house at around 12, maswali ndio hiyo, hata karibu wanakataa kufungua mlango. Na ikifunguliwa maswali, most of you are here, I'm married, you know what I'm saying. Ile maswali mnaulizwa, you cannot be able to answer. So you go to bed mmekasirikiana na ukicheza hata bros imekuwa exchange because you must say ni kazi gani hii leo inafanywa mpaka 11. Lazima useme. So kesho asubuhi you must come up very early in the morning. Na umekasirika, unajua hata hujalala vizuri, makelele nini, kichwa, all those. Alafu customer anakuja hapo kwa reception na anaanza kuuliza na hii inafanywa aje? Then you find that umemkasirikia na yule customer anafanya nini? Anatoroka. So the going concern of the customer can, or rather of the company, become affected. Now, if we come to our case here, because some of us are already affected, for the last 1 or 2 weeks, zimeona zile classes mnaitwa Sundays. Kama jana hivi kuna watu walisoma karibu mpaka 7. Ni Saturday walisoma mpaka 7. 8:30. Yes, that's what now I'm saying. Lazima mwalimu awaite. Yes, kutoka saa 4. Oh, leo kuna ingine. Yes, now you see what I'm saying. That's what I'm saying. And the reason as why that is being done is because mwalimu knows ikifika end of the semester ataulizwa did you finish the syllabus. So sasa yeye lazima awaite Sunday, awaite clear in the morning, awaite usiku, ndio ikifika ile date yeye akuja aseme syllabus yangu nimemaliza, enda watu waangalie kwa wanafunzi. But now the question is, are these students happy with what has been done? Wengine wetu tunawagonga handouts. Remember the last semester when I was teaching, yeah? Nawagonga what? Handouts. Kuja na discuss kidogo syllabus imefanya nini? Imeisha. But we need to ask the big question of are our students happy with that policy? But we had no choice. We had to do it. So those things are the ones that we are calling the dysfunctional consequences. So how do you remedy them? How do you remedy? One of them is we prolong the measurement period. Sasa kama hii syllabus kuisha this week, we should prolong, but unfortunately we cannot because mtihani is the other week. Sasa hatuwezi kuendelea kuwa tunafunza na mtihani inaendelea. Kama ni waite after exam na pia kuna kitu hatumemaliza kuja so that one. Number 2, you also look at what we call qualitative factors. Unasema ni kweli mwalimu alifaa kufunza 16 topics lakini amefunza 13. Na hizi 13 amefunza vizuri kabisa tunaelewa. So you also look at the qualitative. The other thing is you include some adjustments. Na hizo adjustments ndio zile tulikuwa tunafanya juzi kwa IVA. Naona tulikuwa tunaanza na conventional income, then tunafanya adjustments plus or minus. So those ones are used to moderate. So I think that is all that I needed to say. That. Now, as I said, these things are also very practical in life. And it's something you should embrace because you people are still very young. When you start getting money, you have 2 options. You can take project 1 or project 2. Project 2 ni ile nilikuwa nasema conspicuous spending, inakuwa inaonyesha you are doing so well. You have now gotten a job, sasa you are driving a good car, you are living in a posh estate, a big house. Na hizo vitu ni nzuri. I have no problem with them. They are good. But if you choose this one, this is where now kamshahara kakikuja unachukua only a third. You live on this a third. You go invest to that. Hata runua tu mashamba mengine huko hata tukani wapi. With the time hizi zitaanza zitapiduka ujipate huko. So 10 years down the line, now you can even afford to sell them, buy yourself a big car, build a big home, those kind of things. But ukianzia hapa, chances are unajipata. Na unfortunately wakati unajipata huku, ndio nazo expenses za maisha zimeanza kubuild. Hapo ndio mtoto wako ameanza kuingia form 1, ndio ameanza kuingia college, ndio daktari ameanza kukwambia chunga nyama, chunga sukari. So na sasa mambo iko hapa, you need to be very careful. Yeah. You need to be very careful. And please overcome the mentality of nihawe kimesio. You know, mostly when people are given an advice, nasema yawe kimbe mimi nitajipanga, mimi nitachukua maisha hapa na bado nitastukia kupata au kujipanga. Na usifikiria you are too young. You know, kitambo nilikuwa naambiwa mtu ni 25 years. Naona huyu mtu ni mzee. Wakati nilifika 25, sikuwa najisikia mzee. Ukiniambia mtu ni 35, huyu ni mzee. By the time nifike 35, itakuwa nimejipanga. Nikafika 35, bado sijisikii mzee. Nimepita niko past 40, bado sijisikii mzee. But ukweli ni kwamba maisha inafanya nini? Mesonga. And it's not too long. So it's something you can apply in personal life. Good. That was, by the way, it's not part of AMA. Now, on your own, you can attempt September 2021, question 1C. September 2021, question 1C. You know, even the teachers are also complaining. It's not only you, because even the teachers now are saying, what do I do? Syllabus ndio hii lazima ni hizi. Hata imekataa. Hapana. Kasi na tuliona ile statement walitoa last time earlier this year. Wakasema hii mtihani ya March ni ya wale walikuwa wameanguka 1 or 2 papers last it. Si ya wale wanafanya 3 papers. Remember that communication? Yes. So according to CASNEP, you have a whole 6 months ya kusoma. So hii ni wewe umekimbia. Wewe umekimbia. Kwa sasa kama umepewa mpaka August, si ungetulia tu usome pole pole. Sasa ukienda kufanya ile Julai malize. Okay. Let's solve this one of December 2014. December 2014. Is on page 75, 76. December 2014, question 3B. So the question says that WMT Limited is a manufacturing company which has 3 divisions, namely X, Y, and Z, distributed in 3 countries. The company does not allocate corporate and office costs or interest on long-term debt to the divisions. The summary of the results of the company and its divisions for the year ended that 1st of October 2014 are provided below. So we have the operating income, the variable cost, the interest, all that. Then we are told, using the return on investment criterion for each division and the organization as a whole, advise the management of WMT for the most profitable division. So we can start with the return on investment. Return on investments. So we can have division. Now this one we know it is income over assets times 100. That would be the return on investment. So if we start with X, you can see the operating income is 720, and the assets are 3,000 times 100. Twenty-four percent. Let's come to Y. Y, you do the same. 900 over 6,000 times 100. %. Z is 1440. You divide by 9,000. 16%. Then we have the company. Now, company, you can see there is the operating profit of 30, 60. But now you can see in the head office, there are some costs. Here to 40 is supposed to be subtracted here to 40. But interest on long-term debt, that one will not be subtracted. Reason being, the other time I told you interest should be added back. Head office. So interest should be added back. Now, these figures that we have used, in 720 and 900, they had not subtracted interest. They are not after interest, they are before interest. So that's why we shall not include that. And then the fixed cost of head office, that should be subtracted. So minus 360. Now all this you divide by the assets. The assets are 19,500 times 100. Huh? 12.6. 62%. Are you okay? That is what I said the other time. If you look at the income statement, there are various items that contain the word income or the word profit. And you need to know when we say this is net profit, what has been subtracted and what has not been subtracted. When we say this is gross profit, what has been subtracted and not subtracted. So here we are using the operating income. Now the operating income is simply the revenues minus the operating costs or the production costs. So by the time you have operating income, you have not brought on board the financial costs. Yes, so they are not subtracted. And because we are doing a comparative analysis, fairness requires that the figures you have used here be the same. Otherwise, ukikuja hapa huyu subject to interest, while these others are not subjected to interest, then they are not fair. Yeah. So that's why we are not including it. But this Kina 720 and the 900, they already have included the production cost. So kama kuna variable cost and fixed cost that were not included in the head office, they should be factored together. Good. The next one is residual income. We are told to get the residual income. Residual income. So here we have the division, and residual income, it is simply income minus cost of capital minus cost of capital. This is residual income. So ukikuja kwa division X, utachukua 720, that is the income, minus the cost of capital. We are told, are we given the percentage? No. Yes, in requirement 2, compute the residual income for each division, assuming that they require 10%. So 10%, and you see they are insisting 10% of total assets. If you remember what we said the other day, these assets here are the net assets, and net assets are obtained after you subtract the current liabilities. That's what we insisted. But this question is saying you use the total assets, so you're not supposed to deduct the current liabilities, and in any case they are not given here. So times 3,000. So do that for the others. Very good.
Hiyo ni interest, yes. But hizi zingine iko na interest gani?
So they will so you are the ones.
And you don't subtract. So you want to tell me that the head office has interest already? The 3060 iko na interest already? I think so.
Because this 3060 is a product of adding 720 standard and putting 40, which already has interest there.
Yeah.
So this one is already has interest in it. So you add the adding points.
Umezi add to 40, 1200, the 16 of that. Labda amesema operating income watakuwa production base. Operating income ya production base. Ndio, tunatoa sasa tunatoa mali hapo. Na jengo na kusikia
So you are through. Oh, we had been told to say which department is more successful. Hapa ni X, according to return on investment is X. Na kulingana na residual, who is better or who is best? Z. Okay.
For the company advisors and how it's supposed to get.
It's basically the same. In profit. Then you raise 10% of this. On your own, you will try late 2016, question 5B. May 2016, question 5B is on page 59. Page 59, so that I can handle the last question I want, then I run away. So that question is the question of May 2015, question 5B. May 2015. In 2015, question 5B is on page 73. So page 73. So the question says, we are there already. The summary of financial information for Great Group Limited is as follows. We have revenue, profit before tax, income tax, profit for the period, dividends, retained earnings, non-current assets, current assets, total assets, financed by total equity, long-term debt, capital employed. Additional information is that the capital employed at the end of the year 2012 amounted to 279 million. Great Group Limited had non-capitalized leases valued at 16 million in each of the years 2012 to 2014, which were not subject to amortization. Amortization of goodwill amounted to 5 million per year in both years 2013 and 2014. The amount of goodwill written off against reserves on acquisition in years prior to 2013 amounted to shillings 45 million. Great Group Limited's pre-tax cost of debt was estimated to be 10% for both years 2013 and 2014. The group cost of equity was estimated to be 16% in 2013 and 18% in 2014. The target capital structure is 50% equity and 50% debt. The rate of taxation was 30% in both year 2013 and 2014. The economic depreciation amounted to shillings 40 million in year 2013 and shillings 45 million in year 2014. The amounts were equal to the depreciation used for tax purposes and depreciation charged in the income statement. Interest payable amounted to shilling 6 million per year in both years 2013 and 2014. Other than cash expenses amounted to shilling 12 million per year in both years 2013 and 2014. Now for both years 2013 and 2014, estimate the economic value added. Economic value added. Before we draw the economic value added, we will need to get the weighted average cost of capital. The weighted average cost of capital. How do you get that? Weight of equity, cost of equity plus weight of debt, cost of debt, 1 minus tax rate. Good. So in the year 2013, so WACC in 2013, we are told that the capital structure is 50-50. So this is 50%. And the cost of equity in that year, according to information 5, is 16% plus 50% of the cost of debt. According to information 4, the pre-tax cost of debt is 10%. And according to information 7, tax is 30%. So 1 minus 0.3. $11.5. Then WACC in 2014 is 50% of 18 plus 50% of 10 times 1 minus 0.3. $12.5. $12.5. So we now draw today. I'm not getting clearly what you're saying. Are you able to hear me? Okay. You can hear and see, then that's okay. So we are drawing economic value added statements. Economic value added statements. Economic value added statements. Lydia, you're saying you're not able to see. Kindly restart your gadgets. Kindly restart your gadget. What about the others? Are you getting us on and off? Jude, Benta, and Terry? Are you getting me uninterrupted? Okay. Yes. So then, Lydia, adjust your gadgets. The others are okay. Yeah. So we have details here. We have the year 2013. in the year 2014. So December, we always begin with conventional income. Conventional income. So you see, like now here in our statement, we already have two figures that contain the word profit. You can begin with the profit before tax. You can also begin with the profit after tax. So that is the one that I want us to start with, the profit after tax. So that here you put 67, and here you put 82. Then you bring the adjustments. Unlike the other question we solved last time, this one does not have the head office. And I told you if there is a head office and the head office has anything, that is the first thing to adjust. So here we don't have. So if we do not have, then we seek for the others that could be due for adjustments. And this one, you go straight to the additional information. You start checking one by one. When we get to information 1, that is about capital, no adjustment. But information 2, it has non-capitalized leases. Now, these leases, according to financial reporting, they are not assets. A lease, when you have a lease, that building is not yours, or that land is not yours. But if you look at the practice, they recognize a lease like it is your property. When you are registering a school, for example, or any other institution, if you don't have the title, they will ask for a lease, a registered lease. That means then they are taking like that building is yours. Otherwise, you cannot be registered. Like now, ourselves, a school like this one, we could not be registered without a lease. Because a lease, at least you have signed a legally binding contract that will be here for the next 6 years. So that's a 6-year part hammer until 6 years are over. Now, ukihama, there are dire consequences of breaching what? The contract. So the government cannot just approve you and you don't have a permanent place. Ndio usikuje uite wanafunzi hapa uchukue pesa kesho ufunge. So we must be sure uko kwako. So that means in practice, this is recognized as an asset. So FR should then start recognizing it as an asset, and because they don't, so for us now we must add it back. So the non-capitalized, we will need to capitalize. So we add back leases. And we are adding it back because in FR, they treated it as a current expense. Ikatolewa in the computation of the profit. So we are returning it back. In each year, it is 16. Each year, 16. Number 3, amortization of goodwill amounted to 5 billion per year in both years. The amount of goodwill written off against reserves on acquisition in years prior to 2013 amounted to 45. So goodwill, we say it should be adjusted. I think I explained in details why we need to add it back. So what we are going to adjust at this point is 5 here and 5 here, because those are the amounts that go to the income statement. Ones that go to the income statement. The next information, number 4, we already have used it. Number 5, number 6, and number 7, we already have used them. Number 8, the economic depreciation amounted to 40 million in year 2013 and 45 million in year 2014. The amounts were equal to the depreciation used for tax purposes and depreciation charged the income statement. Now, what happens is in regard to the depreciation, although now here it's not going to be to affect us, there are two ways of getting depreciation. The first one is the cost method. Cost method is where you compute depreciation on the basis of the initial cost. Like the question that we have just had, ile tumeanza nayo hapo tuangalie. Ile ilikuwa ya project 1 and project 2. If you look at that question, we have computed depreciation on the basis of the cost of the project or rather of the machine. And we have spread it for the 4 years, such that at the end of the 4th year, the closing value was what? 0. That means when you come now to the 5th year, the opening value of that asset will be what? 0. In actual sense, you are telling us this asset will not be with us at the beginning of the 5th year. It may be true, it may be untrue. Now, if it is untrue, that's where we have the issue. For example, this vehicle is still with us. So the 5th year, we are using the vehicle, and therefore we are getting some benefits from that vehicle. But there is no amount to be charged for depreciation. So when you are put on the test of matching concept, you will have failed because you are recognizing some revenues which do not have a cost. So according now to Eva, you should depart from the cost method and embrace what we call the economic method. Economic method is where you charge depreciation based on the usefulness of the asset. As long as the asset is there and is useful to do, you get a way of charging some depreciation so that ukiwekwa kwa vipimo za matching concept, you are able to pass because you can show the revenue, you can show the costs. In complying with that, when you have an income statement where depreciation has been charged on the basis of cost, you are supposed to add it back and then you less the economic depreciation. In our question here, we are already told that the amounts, the economic, you can see the economic depreciation, and then the other sentence says the amounts were equal to the depreciation that was used for tax purposes. That depreciation that was used for tax purposes is the one that we are calling what? Cost. So maybe what I can do for purposes of record, we can write depreciation here instead of ignoring it fully. We have the cost and we have the economic. Then the economic, I'm saying, is supposed to be subtracted. And because we are told they are equal, you add 40 and then you less 40. You add 40 and you less 40, at least for record purposes. Oh, the 45 the other year. Okay, 45. So in case they are not equal, the difference now will affect. The other argument is, now like in that question that we have just looked at, where at the end of the 4th year, we have 0 value. In each of the 4 years, we were charging depreciation. And a similar, an equal depreciation, it was 25, 60, or 10 something, like something like this. Now, this is based on the assumption that this machine or this asset will be with us from year 1 to the end of the 4th year. It may be true, it may be untrue. If it is untrue, that is now where again the case starts. This vehicle, we have bought it year 1, but around May, March, or May, August of the first year, the vehicle is either stolen or it has an accident and it becomes a write-off. The first year is not over. So do you now continue charging depreciation in the second, third, fourth year, while actually the vehicle is not with you? If you do, then you'll have violated much because you are showing us costs which do not have revenues. So you must get a way of returning back your depreciation. You have to allocate to the 4 years. You rudisha hapa the first year, and then you write off that machine. So that's why now the cost should be added back and less the economic. Interest payable. So interest, I have already said it should be added back. Interest should be added back, obviously net of tax. So for the first year, it is 6. So net of tax, you multiply by 0.7, because tax is that %. So that gives us what? 4.2. So the same case here, 6 times 0.7, that is 4.2. Should be added back. Non-cash expenses. So the non-cash should also be added back. This is where people manipulate accounts by including non-cash. Including non-cash, and you think they are doing so well. But actually they are not doing well. Or you think they are doing well, but actually they are doing well. Can be either way. The other day I saw ABSA, they reported a very huge increase in profit. But when you look at the details, it was there were big allowances. Rather, this year now there were no allowances on what they call them the separation costs. See, ABSA used to be the big backers from UK. Now they parted ways to come back in Africa, right? So that separation costed a lot of money. So this year now there was no that cost. So they came in, and how they reflected it is like it is part of the incomes. So they reported a very high profit. But in actual case, kuna hiyo pesa kwenda kwa bank. So they are called non-cash. They are also used kwa FMs inaitwa hostile takeover. Yes. So if someone targets you for hostile takeover, you can make yourself unattractive by including very high non-cash expenses. Yeah. So these non-cash, they should be added back. We are told they are 12 million per year. So you add back and you add back there. Now, this is a good case of what I was telling you. Kama hujui ni gani inatolewa wapi, wewe weka zote. Na kama hujui ni gani inatolewa na gani ya kuacha, just give them with one side. Kama sasa hizi zote ungeziacha na ungeziacha zikiwa positive, it's only these that would have missed. The others are yeah. So when we do that, we get revised income. Revised income. One oh 4.2 11.2. So let's now come and have conventional capital. Conventional capital. So conventional capital, we always use the opening. Ukiangalia hata hiyo swali tulitangulia kujibu, we use the opening values to get the return. So we always use the opening value. So that then means we will go to information 1. When you go to information 1, the closing for 2012 was 279. That now will be the opening for 2013. Here is 279. Use the opening value. Use the opening value. Similarly, when you look at the account statement of financial position for 2013, the closing capital employed is 340. So that is the one that will be brought to 2014. Then you bring the adjustments. So for hedging purposes, hiyo tulisema unaleta kila kitu iko hapa juu, unaleta hapa for hedging. But for the real thing, you must know who should go there. And it's very simple because it's just knowing who among these finally goes to the statement of financial position. So the first one is leases. Under normal financial reporting, leases do not go there because they are treated as current expenses. But in the confines of EVA, we are saying they should be capitalized. So when you make it capital, then it should go to the statement of financial position. So we bring it here. 16. Twende kwa goodwill. Now goodwill, in effect, it does not go to the statement of financial position. In effect, because it is recognized as an intangible asset, and tulisema juzi, immediately you recognize it, then you also write it off. Because there is no any agreed upon method of how to arrive at the goodwill. So what has happened in this company, they have been writing it off. So now we are saying we to erudition. So we bring it here, goodwill. In the prior years of 2013, walikuwa washang'oa goodwill of what? According to information 3, they had already deducted goodwill of what? 45. So in 45, we need to bring it back together with what was written off this year, this 5. So we are going to bring 50. We're going to bring 50. When you go to 2014, you must bring back what had been deducted previously, which is now 50, plus what you are deducting now, 5. So this is 55. Depreciation does not appear in the income, in the statement of financial position. That's it. Obvious, you are. If you look at the statement of financial position, does it have depreciation? Eh? Yes, equal. So when I say it does not appear, am I right? Yes, it does not appear. Kwa paper-wise, see, if you look at the format of the statement of financial position, see kuna cost, column ya cost, then kuna accumulated depreciation, then kuna net value. Sasa hii net value ndio inateremkana na hizi zingine. That tells you that depreciation does not appear in the statement of financial position because it is already deducted. So whoever proceeds na safari is net of depreciation. So depreciation should not come. Okay. Interest. Does it appear anywhere in the statement of financial position? No. Don't take it there. Non-cash, they also don't go there. So that is all that we could add back. And therefore, if we add back that way, we get revised capital. Revised capital. So you see again, what I'm telling you, kama ulikuwa umeleta zote, you would have missed, you would have gotten at least one. This one, This is out the pattern. Because most likely I will be hard. But at least it's better than trying to sort them out. Unaona kama hapa venye tumechagua, kuna uwezekano zile utaweka sio zenye zinahitajika. Yeah. So instead of taking that risk if you are not sure, weka kila kitu. You cannot be penalized for variety. So here. 345 and 411. But I'm not saying you go right in 311 things. You can become a nuisance. So after the revised capital, let's get cost of capital. Cost of capital. Down there, cost of capital. In our working huko juu tulikuwa tumepata what percent? 11 points. So 0.115 times 345. Right? 675. Huyo mwingine tulipata what percent? So 125 times 411. 375. Then finally, economic value added. Economic value added. Economic value added, same now, it is the based income. So it is 104.2 minus that 9.675. Mm-hmm. 60 points. Okay. 64 points. Alafu huyu mwingine ni 119.2 minus 51.375. 825. So that company is doing well. The value added is increased. So for practicing that, you can attempt September 2015 question 1A. It's on page 64. Attempt that. Therefore, we call it a semester at that point. kila mtu ajitetee. Kwa ndebe sasa. So I think what we have done is enough. As I told you the other day, you cannot know it. There is only God who knows it. So it's pressure sana, focus on what you already know. Don't focus on what you don't know. Yes. And even in what you already know, prioritize the topics that you understand so well. Focus now more on them. That's why the other day I said you take time and concentrate on the theory. The topics that have been giving you a headache, don't give them a lot of attention. Kama hujaelewa tangu Januari, sidhani now in the next few days utaelewa. Yeah, but I'm not saying you ignore them. What I'm saying is don't focus on them so much. The effect of focusing on them so much is that they are likely to make you anxious. They are likely to tell you don't know. And when you go to the exam room thinking you don't know, for sure that I'm doing, it will already be a matter of confirming. But the opposite is true. When you do things that are easy, unafanya, unaona ina balance, unapata answer, you start telling yourself, kumbe hiki tunajua, kumbe hiki si ngumu. And you go to the exam thinking that you know, and again, it will just be confirming. So these are not the times to even now attempt any question that I have not attempted. Kama swali hatujafanya pamoja na sijakupea kama assignment, forget about it. Forget about it. Just revise on the ones we have done, the ones I've given you assignment. Hizo zikikulemea, I'm available either physically or online or wherever you can consult. But the questions we have not done, please avoid them. Avoid the very many questions that come your way. Mtu anashida kuletea anakwambia naona hii kama inaweza kuja. Naona hii kama hii haikuja. And they bring difficult questions. So such people avoid them. Avoid such questions. They will not be good. Again, it's also good to be moderate. Semester ni kidogo. Most of you are working, you are busy. Although now I'm seeing some of you around. Make sure you do everything with moderation. Too much of anything is what? Poisonous. Kifika masaa ya kunywa chai, enda kunywa chai. Kifika masaa ya lunch, enda ukule lunch. Kifika masaa ya kwenda kwa bed, go to bed. Don't make us to be called to handle emergencies. Na si ugonjwa ni chai na kuchukua. So so just do everything with moderation, and above all, involve God, because He tells us when we commit our plans unto Him, He'll be able to establish. So, in as much as I said I don't make prayers in classes, I'm a firm believer that there is a big impact on divine recognition. So we are grateful as an institution that we chose Destiny to be your trainer. We don't take it for granted. We know there are many other places you could have gone to, but out of your free will, you chose Destiny. So we want to say thank you so much, and also to encourage you to tell many others that kina Kimani mewacha hapa na umeona they are still energetic. So you can encourage them to come so that you can teach them. So thank you so much. We wish you all the very best. Those who are finishing in October for graduation. Actually, now everyone should finish before October. Because at our more papers, if you did not manage to combine all of them, sikuna July. Then, because July, for anyone who is not through with the papers this semester, the semester for July is also too short. Too short. Actually, after the exams, that Monday we are back to class. Yes, on 11. Because the semester is exactly 13 weeks. So, kama hujamaliza, come back immediately. Wacha results zikupatane mbele. Kama maliza ni sawa. I don't have any compiled for theory. I have it compiled. I was thinking you would rely on the notes. You have the notes. Yeah, you can rely on that, but in case of anything, you can always talk to me. So thank you so much. God bless you. All the best.